Alright guys, so today we're going to be talking about profit and loss, P&L. Incredibly important to know, to keep track of if you plan to be a profitable trader, right? We're just going to go over some basic knowledge about P&L, some good practices for P&L, some basic knowledge, that kind of thing, and this will just be another video in our trading series as we continue to move through these. Again, I'm just going to let these candles print in the background, and we'll just, as I talk, this is generally one of my main setups like we spoke about in other videos. We can see that we had a crossover here, just real quick, right? And then we can see we had a candle print above the action. We would have taken a long here, and this would have caused a motion, would have caused some people to get out here. But the indicators held strong, and this long is still printing, right? So again, you watch these videos, I practice what I preach, you can make money. Again, a crossover. This we didn't really have a good print after. You had to get in right when the signal through. But again, it's your level of risk. This is more confirmation candle type stuff where we wait for the print. And this is more, high speed traders are going to put a trade instantly as soon as the indicator throws the signal. But let's get back to P&L. What is P&L? Let's get a real broad overview to start off with. In trading terms, P&L stands for profit and loss. It's a fundamental metric that reflects the financial outcome of a trade or a series of trades over a specific period. A positive P&L indicates a profit, while a negative P&L indicates a loss. So generally it is the difference between the revenue generated from a trade or a set of trades and the cost associated with those trades, right? When we talk about costs associated with trades, and this is very big where some people don't understand this, we're talking about possible slippage. Some exchanges charge gas fees, the exchange fee itself, lots of things play into that, right? What the orders are placing at, in the book over here, what they're selling at, can affect your overall P&L. Right? So sometimes I see people are like, oh, I got a 15% P&L, but once, maybe on a $100 trade that was $15, but once their fees came out, maybe they made $7, right? You have to know where you want your P&L to be to generate the profit you want, and you have to take into account those things. So when we're talking about P&L, right, we are talking about the best way to keep up with it in trading is called risk reward ratios, right? And you trade for an RR. I generally trade for 1 RR. That means whatever my trade is, I will double that. So when you place a trade, the money you are actually physically taking out of your account is whatever the trade margin is. Regardless of leverage, the margin is what you are paying. So let's say you place a trade for a $100 margin. It doesn't matter if it's a no leverage, a 50 leverage, a $500 or 500x leverage. $100 will come out of your account. Now, if the trade goes your way, then all P&L is positive. 1% P&L would be $1. So you would have made $101. You've gotten your $100 back plus $1, which you wouldn't have gotten because of fees and all of that. So, you would need, again, to know what percent P&L you need to trade at. I go for trades at 100% P&L. I tend to not get into a trade if I do not believe I can get a 100% P&L or 1 RR, meaning if I place a $100 margin trade, I would generate $200 on that trade, therefore getting my $100 back, and then my $100 on top of that. So it would be a $200 profit for me, because when the $100 margin call is placed, anything over the 1% is the money back. So you want to go for 100%, which is your money back plus the $100. Again, that is a safer way to trade. Some people do trade for 2RR. You know, you can even trade for 0.5RR, 50% PnL, which would mean you'd make your money back plus 50% on the $100 example. You would make $100 plus 50, so $150, $50 being your profit. So it all depends on your risk tolerance, right? Something as well to know, and we will get into this in another video, but we'll briefly touch on it here, is let's talk about leverage. So leverage makes capital more efficient, is basically what it comes down to. Now, more leverage equals less market movement you can sustain before you get liquidated. Less leverage equals more market movement you can sustain before you get liquidated. Essentially, let's say you're trading at 500x leverage, and you know, just in general terms, you'll be able to, unless you have like, you know, a ridiculously buffered account, you'll be able to sustain market movement of a few $100s one way, you know, against you before you'll hit your forced liquidation price, because you're trading at such high leverage, right? Now, let's say you were to trade 25x leverage on a $100 trade, right? You'd be able to sustain market movement in the thousands, right? If you were trading on a decently, you know, buffered account. And what I mean by that is you shouldn't, each trade you place should be roughly 10% of your bankroll, and you should not trade cross margin, right? We're getting into a lot of things here. We're getting down the rabbit hole a little, but you know, solo margin, single margin, one call at a time. Do not place one call on Bitcoin and then another call on Solana, and then try to monitor all these calls at different lengths of time. That is a bad trading practice, right? It does not lead to being consistently profitable. You might make a lot of money here or there, but overall, in the long game, you will be in the red, right? One call at a time. I tell that to everyone I try to help. One call at a time. Do not get in the middle of a signal. This is the signal we would not get in no matter what, as much as we'd want to, on a long call, right? Because a long call already happened here. It's in progress. The long call is in progress, right? We're going to wait for everything to ratchet back down, and we're going to wait for a short, and then we're going to place a short. I generally only like to place one call on one thing, and I alternate. I'll place one long call, and I'll ride that long call for as long as I can, and then I will not place another long call unless the market is just begging me, right? Sometimes the market's going to jump again, and you know it. You know, there's signals, right? But generally speaking, you get in on a long call, you get out wherever you feel comfortable getting out, and then you wait to get in on a short call. And then you get in on a long call, and you get in on a short call, right? And that's the flow of things. That's the ebb and flow of trading, right? Let's say you were like, man, I need to get out right here. I really hit my RR. We're above it. Woo, take profit. And then the market keeps going up, and you're like, oh, man, I want to get in right now. You would not get back in, because you have no idea how much longer this trend based on these indicators is going to last. You would need all these other indicators, which I also use, but rarely do I get back in the middle of a trend, right? Something to know about. But so again, more leverage, you can sustain less market movement before you are liquidated, right? It would set your forced liquidation price lower. Like maybe you get in 103,000 for Bitcoin at a 500x, and then you would be forced liquidated like 103,000, like 300, right? Where if you got in at 25x, you might be liquidated at like 105,000, right? So again, trade with 10% of your bankroll. That is a good rule of thumb. As well, there is realized versus unrealized gains, but being as generally I preach intraday trading, you know, scalping, and not long-term swing trading, that's not really a thing. You would want to get out when you're losing money and get out when you're making money. So we wouldn't be waiting for an upswing or a downswing. Our stop loss would get us out in a big downswing. Our take profits. If I rarely use stop loss and take profit. I live trade. I sit here and I watch and I monitor. But that is a good practice if you're not good at live monitoring. Sorry about that. But again, that's generally just what to know. You need to set your RR. One RR is very achievable and it's high profit. Like I said, you'll double, your money basically every time. Even 50% is something good to shoot for. So I hope you guys learned some things. We got to see one good entry point here and continue to trend up. And we'll get back to some live trading here in the next couple videos. All right, till the next one.